Welcome to Pacific States University's online lecture series for BBA 302, Economics for Business. Today we are diving into government policy, exchange rates, and the US dollar. Up until this point in the course, we've often looked at economies somewhat in a vacuum. We've talked about domestic supply, domestic demand, local labor markets. But let's be real. The reality of modern commerce is that we live in a deeply, inextricably interconnected global economy. We're talking about trillions of dollars crossing national borders every single year. Modern firms don't just operate in one town. They might buy raw materials from one country, manufacture their goods in another, and then sell the final product in yet a completely different market. And to pull all of that off, they have to navigate the constantly shifting, sometimes turbulent waters of foreign exchange. So for today's lecture, we are going to exhaustively explore exactly how these currencies fluctuate, the underlying mechanics of those movements, and the specific macroeconomic policies governments use to manage their money on the world stage.
Here is our roadmap for this session. We'll start with the foundational mechanics in Part 1, the foreign exchange market. Then we'll move into Part 2, the currency winners and losers. From there, we'll dive deep into Part 3, supply and demand dynamics, followed by Part 4, exchange rate policy choices. And finally, we will wrap up by weighing the incredibly difficult choices in Part 5, the trade-offs of intervention. Let's jump right in.
Section 1, the foreign exchange market, and how we actually move money across borders.
To really grasp the foreign exchange market, we first need to understand the sheer scale of it. I want you to just think about this number for a second. $6.6 trillion. We are talking about a staggering $6.6 trillion worth of currency exchanges occurring globally every single day. That is an almost unfathomable amount of money. Now, when you hear currency exchange, you might immediately picture a tourist at an airport kiosk trading $100 for some euros before vacation, but that is just a tiny, microscopic drop in the bucket. The vast majority of this $6.6 trillion represents massive digital transfers, the lifeblood of global supply chains, and enormous flows of international financial capital. Think about a German firm that exports heavy machinery to Russia. They sell the machines and they earn Russian rubles, but they can't pay their workers in Munich with rubles, right? They can't pay their German domestic taxes with rubles. They absolutely have to convert those rubles into euros. Now, multiply that exact same functional need across millions of multinational businesses, governments, and global investors every single day, and you quickly see how we hit that $6.6 trillion daily volume.
Which brings us to our formal definition. The foreign exchange market is exactly that. It's the market in which people, or more often large firms and financial institutions, use one currency to purchase another currency. And here is the crucial conceptual leap for this course. The exchange rate isn't just some random mathematical conversion factor. It is a price. It's the literal price of one currency expressed in units of another. We are used to thinking of dollars buying goods, like an apple or a car. But in the foreign exchange market, currencies themselves are the goods. Whether you're a tourist trading dollars for Turkish lira or a massive multinational corporation moving millions of dollars to fund a new factory, you are participating in a market where currency is a commodity being actively bought and sold every single second of the day.
Section 2, currency winners and losers. I call this the double-edged sword of a strong dollar.
If you watch financial news, you always hear politicians or pundits demanding a strong currency. A strong dollar just inherently sounds like a great thing, doesn't it? Who wouldn't want their money to be strong? But economically speaking, it actually creates very distinct winners and losers depending entirely on where you stand in the market. Let's break this down. If the US dollar is strong, it is fantastic for US tourists traveling abroad. Your dollars suddenly buy a lot more euros or yen, making your vacation much cheaper. It's also phenomenal for US importers. Businesses bringing in foreign goods can buy them on the cheap, which keeps prices low for domestic consumers. But, and this is a massive but, that exact same strong dollar actively hurts U.S. exporters. Let's say Ford manufactures a truck in Michigan and prices it at $25,000. If the U.S. dollar suddenly strengthens significantly against the British pound, that exact same truck, without Ford changing a single thing about their manufacturing process or their costs, suddenly costs a British consumer thousands of pounds more. Ford just became massively less competitive in the UK market simply because of the exchange rate. Conversely, look at the other side. A weak dollar is actually an American exporter's best friend. It makes American-made goods much cheaper and highly competitive to foreign buyers. A weak dollar also acts as a magnet for foreign tourists visiting the U.S. and foreign investors looking to buy U.S. assets at a discount.
So when someone asks you if a strong dollar is good or bad for the U.S. economy, the only true, accurate economic answer you can give is, it depends. It depends entirely on whether you're asking an American manufacturer whose products are getting priced out of foreign markets or an American college student who is enjoying incredibly cheap lattes in Paris. In macroeconomics, there's rarely a universal benefit. Every shift in these massive global scales helps someone and hurts someone else.
Now, to really understand why these currencies strengthen or weakened, we have to isolate who is actually out there demanding US dollars. In the foreign exchange market, demand generally breaks down into three main buckets. First, we have US exporting firms. These are companies selling products abroad, earning foreign currency, but they desperately need to convert that back into dollars to pay their domestic expenses like payroll and rent. Second, we have foreign tourists visiting the United States. They arrive with euros or pesos, and they need dollars for their hotels, their meals, and their shopping. And third, and this is a huge one, foreign investors making direct investments in the US. Imagine a Japanese automaker wants to build a massive new assembly plant in Ohio. They don't pay American construction workers in yen. They have to take billions of yen into the foreign exchange market, supply that yen, and demand billions of US dollars to fund the project. All three of these groups are actively buying dollars, creating the demand side of our market.
Section 3. Supply and Demand Dynamics. This is where we see exactly how currencies fluctuate in real time.
Let's apply standard microeconomic principles to this macroeconomic stage. Think about what happens when the U.S. Federal Reserve decides to raise interest rates. Higher interest rates essentially mean higher guaranteed returns on U.S. financial assets, like government bonds. Suddenly, holding U.S. dollars becomes highly attractive to global investors looking for yield. So, global investors rush in. They take their foreign currencies and start aggressively buying dollars, which causes the demand for U.S. dollars to surge, shifting our entire demand curve to the right. But that's only half the story. At the exact same time, U.S. domestic investors who might have been looking to invest overseas look at those new high domestic rates and decide to keep their money right at home. This means they are no longer supplying dollars to the global market, shrinking the global supply of dollars and shifting our supply curve to the left. When demand skyrockets and supply shrinks simultaneously, what happens to the price? It shoots up. The price of the dollar rises. This is pure, unadulterated market forces at work.
And when a currency's price goes up like this, due to market demand, we call it appreciating or strengthening. It is now worth more in terms of other currencies. And here's a foundational rule you must remember for this course. Exchange rates operate exactly like a seesaw. If the US dollar appreciates against the Mexican peso, the peso must, by mathematical definition, depreciate against the dollar. It is completely impossible for them to both strengthen against each other at the exact same time. One goes up, the other goes down.
And that, naturally, brings us to the concept of depreciating or weakening. Remember, a depreciating currency isn't inherently an economic failure. It's simply a price adjustment reflecting market realities. It just means it takes more of this currency to buy a single unit of a foreign currency. Sometimes, though, this depreciation happens violently and rapidly due to geopolitical events. A classic example is right after the Brexit vote in the UK back in 2016. Global investors suddenly panicked about the massive uncertainty regarding UK trade. They didn't want to hold British assets anymore, so they dumped them. This created a sudden massive supply of British pounds flooding the foreign exchange market, which caused the currency's value to absolutely plummet, rapidly depreciating to 30-year lows. If you are an international firm operating on thin margins, sudden swings like that can literally wipe out your entire year's profit overnight.
Now, while daily news, investor panics, and interest rate changes drive those short-term swings, the long-term values of currencies are ultimately anchored by a concept called purchasing power parity, or PPP. PPP basically states that over a long time horizon, exchange rates have to reflect a currency's actual buying power in terms of internationally traded goods. Why must this be true? Because of the most powerful force in finance, arbitrage. Arbitrage is the pursuit of guaranteed, risk-free profit. Let's imagine a scenario where an internationally traded commodity, like steel, was suddenly vastly cheaper in Brazil than it was in the US, even after factoring in shipping costs. What would happen? Smart, aggressive trading businesses would immediately jump on this. They would buy Brazilian reals, use them to purchase that cheap Brazilian steel, ship it, and sell it in the US for a massive premium. But think about the currency mechanics of that action. To do this, they have to buy Brazilian reals on massive scales. All that sudden relentless demand for the real would cause it to appreciate, becoming more expensive, until the price of that steel roughly equalized between the two nations. The market corrects itself over the long run.
Section 4. Exchange rate policy choices. Up to this point, we've mostly talked about the free market. Now let's see how governments and central banks actually intervene.
Governments don't just have to sit back and watch their currencies bounce around. They have options, and these policy options exist on a spectrum, ranging from absolute, untouched market freedom on one end to total, rigid government control on the other. Let's thoroughly examine the four main strategies central banks use to manage their money on the global stage. We'll start at the free market end of the spectrum with floating exchange rates. Under a floating regime, the government completely steps back. They let the foreign exchange market, the daily billions of private transactions by tourists, firms, and investors, entirely determine the currency's value. The US dollar operates on a floating rate, as do about 40% of all global currencies. The primary advantage here is efficiency. The government doesn't have to spend resources intervening, and the currency acts as an automatic shock absorber for the economy. The major downside? Volatility. Because it's up to the market, floating rates can swing wildly from week to week, which makes long-term financial planning incredibly difficult and stressful for importers and exporters.
Now, if that free market floating is just too volatile for a nation's economy, governments will use what we call pegs. With a soft peg, the government generally lets the market dictate the daily rate, but the central bank quietly draws invisible boundaries. They essentially lean against the wind. If the currency starts appreciating or depreciating way too fast, the central bank steps in. They intervene by buying or selling massive amounts of their own currency reserves to artificially nudge the price back to a stable level. A hard peg, however, is a totally different beast. With a hard peg, the central bank leaves absolutely nothing to the market. The government legally fixes the exchange rate at a specific number, and the central bank must constantly, aggressively intervene in the market every single day, buying and selling whatever is necessary to ensure the price never, ever deviates from that exact mandated peg.
And finally, at the absolute strictest, most controlled end of the spectrum, we have a merged currency. This is when a nation decides to abandon its own historical money entirely. The most famous example is the euro, which is shared by numerous European nations. Or consider a country like Ecuador, which simply adopted the US dollar as its official currency. Economically speaking, a merged currency is essentially an unbreakable permanent hard peg. It is the ultimate commitment. It provides absolute 100% certainty and totally eliminates exchange rate risk when you are trading with partner nations in that same currency block. But as we will see, that absolute certainty comes at a tremendous macroeconomic cost.
Section 5. Trade-offs of intervention, or the sacrifices of policy.
And this brings us to the core dilemma, the great trade-off that central banks face. There is no perfect policy. If you choose to float your currency, you get a beautiful thing called an independent domestic monetary policy. Your central bank can raise or lower interest rates to fight local inflation or to stimulate your way out of a recession freely. But the sacrifice is that you suffer high trade volatility. Conversely, if you peg your currency, you get incredible rock-solid stability for international trade. Businesses love the predictability. But the sacrifice? Your central bank entirely loses its independence. Their monetary policy can no longer focus on helping the domestic economy. It must now focus almost exclusively on defending and maintaining that currency peg.
I really want to hammer this point home because it is the fundamental sacrifice of international finance. Imagine a nation with a strict hard peg suddenly faces a devastating local economic recession. Factories are closing, unemployment is skyrocketing. Normally, a central bank's immediate reaction would be to slash interest rates to stimulate domestic borrowing and spending. But if they lower interest rates, we know what happens. International investors will immediately pull their capital out to seek higher yields elsewhere. That massive outflow of capital would cause the currency's value to drop. But wait, the central bank is legally bound to maintain the hard peg. They aren't allowed to let the currency drop. Therefore, they are trapped. They literally cannot lower interest rates. They have surrendered their single best tool for saving their domestic economy in exchange for currency certainty. This is exactly why a nation like Greece faced such incredible hardship during its debt crisis. Because they used the euro, a currency controlled by the European Central Bank, Greece couldn't simply devalue its own currency to make its exports cheaper and recover independently. They were locked in.
Which leaves us with a critical thought to end on. We've seen today that every single exchange rate policy requires a monumental economic sacrifice. So, for our final discussion question based on this lecture, if your home country faced a severe, crippling domestic recession, but was strictly locked into a hard currency peg, what exactly should the government do? Should they abandon the peg to stimulate the local economy and risk international instability, or maintain the peg to protect international trade while domestic citizens suffer? It's an incredibly tough, highly debated call, and one I want you to explore deeply in your discussion groups this week. Thank you for joining this lecture, and I'll see you in the next module.